Risk-weighted assets, RWA, exploring the complexities of asset risk assessment. Agenda overview. Definition of risk-weighted assets. Understanding what risk-weighted assets are is crucial for banking assessments. They determine the capital requirements for banks. Importance in banking. Risk-weighted assets play a vital role in evaluating bank stability and risk management. They influence lending practices. Calculation methods. Different methods exist to calculate risk-weighted assets, affecting how banks assess risk. Each method has its nuances. Regulatory frameworks. Regulatory frameworks guide the management of risk-weighted assets. They ensure consistency and stability in banking. Impact on financial institutions. Risk-weighted assets significantly impact financial institution operations and capital allocation strategies. Future trends in risk-weighted assets assessment. Emerging trends will shape how risk-weighted assets are assessed, adapting to new challenges in the financial sector. What are risk-weighted assets? Definition of RWA. Risk-weighted assets are essential for assessing the risk level of banking assets. They help in understanding potential financial vulnerabilities. Risk-weighted assignment. Each asset receives a risk weight based on credit, markets, and operational risks. This classification aids in risk management. Importance for capital requirements. RWA is crucial for determining the minimum capital banks must hold. It safeguards against potential losses and ensures stability. Definition and significance. Define RWA. RWA stands for risk-weighted assets, encompassing total assets adjusted for different risk factors. Capital requirements. RWA is crucial for determining the necessary capital banks must maintain to mitigate risks. Regulatory compliance. RWA acts as a benchmark, ensuring banks meet regulatory standards for financial stability. Components of RWA calculation. Asset categories. RWA calculations include loans, bonds, and equity, each contributing differently to risk. Risk weights. Each category has specific risk weights based on factors like credit quality and market exposure. Importance of understanding RWA. Comprehending these components is crucial for effective interpretation of RWA reports. Importance in banking, RWAs and capital requirements. RWAs are essential in determining the capital banks must hold against risk. This ensures they can withstand financial shocks. Regulatory oversight. Regulators use RWAs to assess bank stability and risk management. This promotes confidence in the financial system. Financial system stability. RWAs contribute to overall financial stability by ensuring banks are prepared for unexpected losses. Capital Adequacy Ratio, CAR. Definition of CAR. The Capital Adequacy Ratio is measured against risk-weighted assets. It reflects a bank's capital strength. Importance of CAR. The higher CAR indicates a bank's capability to endure financial challenges. It is crucial for stability. CAR and resilience. Greater CAR signifies robust financial health, ensuring the bank's solvency during economic stress. Regulatory compliance. Capital ratio requirements. Banks must maintain specific capital ratios based on their RWAs as mandated by regulatory authorities. Operational licenses. Compliance with regulations is crucial to maintaining banks' operational licenses and legal standing. Market confidence. Adhering to regulatory standards fosters trust and confidence in the banking sector among stakeholders. RWA calculation methods. Standardized approach. The standardized approach uses predetermined risk weights for different asset classes. This method is simpler but less flexible. Internal ratings-based approach. The internal ratings-based approach relies on banks' internal estimates of risk. It allows for more tailored risk assessments. Impact on capital allocation. Different methods of RWA calculation influence how capital is allocated across the bank's portfolio. Understanding this is crucial. Standardized approach. Fixed risk weights. Regulators assign fixed risk weights to various asset classes, ensuring consistency in risk assessment. Simplicity of approach. Standardized approach is straightforward, making it accessible for smaller banks. Suitable for smaller banks. This method is typically employed by smaller banks with less complex portfolios. Internal ratings-based approach. Custom risk models. Banks can create their personalized risk models to assess risk effectively. Risk weights determination. The IRB method enables accurate determination of risk weights for various exposures. Regulatory approval requirement. Banks must obtain regulatory approval to utilize the IRB approach. Adoption by complex institutions. Larger, more complex banks are the primary users of the internal ratings-based approach. Impact of RWA on financial institutions. Effect on lending capabilities. Higher risk-weighted assets can limit a bank's ability to provide loans to customers. Profitability challenges. Increased RWAs often lead to reduced profitability for financial institutions. Capital efficiency. Lower RWAs can improve capital utilization and efficiency in banking operations. Lending and risk management. Balancing RWAs and lending. Banks need to align their RWAs with effective lending strategies for profitability. Importance of risk management. Effective risk management is crucial for optimizing RWAs and meeting capital requirements. Capital planning strategies. Importance of capital planning. Strategic capital planning ensures banks align their capital levels with business objectives effectively. Projecting risk-weighted assets. Projecting risk-weighted assets is crucial for determining required capital in response to business needs. Adapting to market changes. Banks must adjust their strategies to changing market conditions to sustain adequate capital ratios. Future trends in RWA assessment. Technological advancements. Technology is reshaping RWA assessments, leading to more accurate calculations. These advancements help institutions manage risks effectively. Sophisticated risk models. Financial institutions are adopting sophisticated risk models to improve RWA calculations. This shift enhances their risk management practices. Data analytics adoption. Data analytics is increasingly used in RWA assessment, allowing for enhanced decision-making and improved risk evaluation. Technological advancements, AI in RWA assessment. Artificial intelligence is reshaping how banks assess risk-weighted assets. It allows for more precise evaluations. Machine learning benefits. Machine learning improves data analysis efficiency, leading to better risk management. Banks can utilize vast data sets effectively. Enhanced risk modeling. These technologies enhance accuracy in risk modeling, supporting informed decision-making and capital allocation. Regulatory changes. Evolution of regulations. Regulations governing RWAs are constantly evolving, requiring attention from financial institutions. Importance of risk sensitivity. Enhanced risk sensitivity is crucial in adapting to new regulatory frameworks. Need for compliance. Staying updated with regulatory changes is vital for compliance in financial institutions. Effective risk management. Regulatory compliance enhances the effectiveness of risk management strategies. Conclusion. Importance of RWAs. Risk-weighted assets are crucial for determining capital requirements in banking. They ensure that banks hold enough capital to manage risks. Impact on lending strategies. RWAs significantly influence lending strategies and decisions by determining how much capital banks must reserve. This impacts overall lending capacity. Navigating regulations. Understanding RWAs is essential for financial institutions to navigate complex regulatory landscapes. This knowledge ensures compliance and stability. Thank you.